And welcome back to Season 2, Episode 2 of Paris and Bazcast, our weekly live stream episodes where we bring to you a number of guest speakers to talk about topics that impact property management, sales and finance, the three services we provide here. And the topic of discussion today is federal budget and its impact on the property market, and specifically the three groups that we are seeing a lot of the policies for. First home buyers, the single parent households, and the downsizers, and what sort of policies have been introduced for that. So hello to everyone coming on. Do feel free to send us a message if you have any questions while we are starting our discussions, if there's anything that we can answer while we are live. The specialist that we have with us today is Manjot Singh. Welcome.
Hey guys.
From Westhill Partners.
After a long time, huh?
It has been, exactly. So he has joined us probably twice before, a number of different
it's been about a year now.
Yeah. So this is all back again, and it's good to have you back in the office, because last time it was on Zoom. So great to have you with us in person to discuss a very important topic, even it was only introduced last week.
Yep.
And some of the policies. So this, whatever we're going to be discussing, comes into effect from 1st of July, so next financial year. But there's been a lot of debate and a lot of conversation about the policy. So let's start.
Yeah. And I think it's just adding on to that, it's worth mentioning that none of this is financial advice.
Exactly.
It doesn't constitute financial advice.
It is opinion based.
We're just providing some information, passing it on from the government through to everybody else through us.
Yeah.
So coming out of COVID, I was reading an article the other day in The Economist. It said basically, look, if you look at the history of the entire world and the universe, normally when there's been pandemics, countries that are richer, we would say, Australia is a richer country, they come out of it in a way where they go through a post-pandemic boom.
Okay.
And the boom is such that it, the GDP growth and everything, it tends to be, you would say, faster and larger than what it was before the pandemic. And the main reason for that is primarily because during the pandemic, you've got opportunity to save. There were lockdowns, people couldn't really go out, so people had a lot of savings up their sleeves. The government was announcing all these grants and stuff, which was adding on to the savings,
Which is true. We can see on the real estate market, the way it's rebounded, the way it's come from last June, July. It's unbelievable, the growth we see in the real estate sector over the biggest, probably in the last 50 years.
So we can say Australia is on the verge of a post-pandemic boom. People are going out there and spending, right? I've seen a lot of clients, they're coming to me with opportunities of how they want to do business, like this year, next year, like new business opportunities are coming around. All right, we've come out of this. What is it there in the market that we can tap into?
Yeah.
So spending has increased. Like business owners are doing a lot of things to tap into those areas. And the other thing is, obviously, like when you're going through a post-pandemic boom, the government then tries to step in and have their own input into all of this. So that's what they've primarily done with this whole budget this time around. It's about rebuilding Australia's economy, getting people to spend more, getting people to do more business, and obviously they're targeting the unemployment rate as well. So part of the, I guess you've already mentioned there are three things that we'll discuss, but part of rebuilding this Australia's economy, I just want to say that the budget didn't really touch on negative gearing as it has done in the past.
Okay.
It didn't really touch on capital gains this time around. There have been tax cuts, and I think that it's worth mentioning them as well. So individuals earning between 48 grand and 90 grand will get a tax offset of $1,080. So $1,080. That was there before, but it's been reintroduced this time around. If you're earning less than 48, then you still get some sort of a benefit, but it's not the full amount of the $1,080. And if you're earning more than $126,000, that's where it stops. So 48 to 90, you get the maximum tax boost, and it's substantial. I mean, it's $1,080. They're putting billions of dollars into this. As far as businesses are concerned, we'll come to property because that's our main one. But as far as businesses are concerned, it's worth mentioning that as well, that they're allowing you to claim your assets to the entire amount. You can write off your assets again
Yep.
for the next 2 years.
Is there a
Right.
threshold on that, on the how much they can write off?
They haven't really mentioned the threshold
Okay.
yet. So obviously it's still got to go through the legislation and approvals and everything.
Yeah, okay.
And they're allowing, you know, what the other interesting one as far as businesses is concerned is they're allowing you to deduct your COVID losses. So if you've had any losses during the period, during the COVID period, you can offset them against previous year profits.
Okay.
Oh, wow.
I personally don't know how that's going to work
Yeah.
in terms of compliance and paperwork.
Yeah.
Mhm.
But if you've had a loss, any business owner that's had a loss during the COVID financial year,
Mhm.
they can deduct it with their previous
Against
year's
the year
profits.
before.
Wow.
So that's a big boost there. All right, so we'll come to property now. The first one, family home guarantee. This is the new one that's been announced.
Mhm.
What that's doing, it's allowing single parents. They have to be Australian citizens.
Mhm.
I think it's worth mentioning that as
Qualification.
well.
Yep.
That's always a question that gets asked.
Yeah.
And
Yep.
both. Well, actually, this is single parent part.
Yeah.
But we'll come to the other part. But so the single parent has to be an Australian citizen, dependents under 16 years old,
Mhm.
but they have to be earning less than $125,000 annually
To be able
To
to
be
qualify.
to be qualified. So
Mhm.
what is it? You only need to come up with a 2% deposit,
Wow.
and
Yeah.
you can buy your house. You know, you can buy a
2%
Yeah.
deposit.
So it's your first house. And with single parents, if they've been married before in the past and they've been divorced and they've had a house while they were married, they still classify as a first home buyer under this scheme.
Oh,
Wow.
Okay, so
Right.
they get a double whammy. Okay.
Yeah, so it's a 2% deposit. But so what that means is government's guaranteeing the 18%. So it's normally a 20% deposit.
Yeah. With
So
the
the
LMI,
government's
yeah.
guaranteeing the 18%. So there's no LMI.
Yeah.
But the important thing to note is, like, it does sound, you know, fascinating,
Mm.
but you still gotta make sure that you have the serviceability there to be able
Of
to
course.
service that
Service,
18% as well.
Yeah. It'll be interesting to see how the banks do
Yeah.
pass this on as well, what serviceability tests there are as
Mm.
well.
Yeah.
How it
And how many
changes.
places they'll be offered and what will be the waiting list with the major banks. Because I remember with the last scheme that was announced, not all the banks were on board.
Yeah.
So let's see which
So
banks come on
hasn't
board.
nothing's been announced at this
No,
point.
no, it's
Mm.
very early days.
Mm. Mm.
Yeah.
Yeah.
Yeah, and I mean, it's obviously providing single parents to be able to get a house.
Yep.
Because owning a house carries its own, you know, social and economic benefits and security. You
Mm.
can leverage off your house and, you know, inject more into the economy. You can start spending more in the future.
Yeah.
Yeah.
So, you know, they're obviously doing this to boost the economy.
Mm. And how many do we know? Like, is there a number of how
Yes,
many
there
people
is.
qualify?
So this, I mean, that's interesting. There's 10,000 places they've just opened up. They're going to open up from the 1st of July this year,
Mhm.
but they're going to run that over 4 years. So that means
Wow.
$2,500
Mhm.
of places every year.
Mhm.
And there's been debate around the fact, is this substantial? You know, it's not much. It's like, if you
So
keep-
only
yeah.
2,500 will qualify per year for the next 4 years.
Yep.
Okay.
And I guess you'll have to go on a waiting list.
Waiting list,
then.
and that's what happened last year with the other deposit scheme. The waiting
Mm.
list, you've got to wait sometimes 2, 3, 4 months as well before you get a place.
Yeah.
And then you
Yeah.
find the property, you've got a certain time period. So,
Yes,
yeah.
it's a great carrot to be dangling, but to be able to
but
get
if you do
to it.
qualify,
Yeah.
you get the benefit and you get the stamp duty concession as a first time buyer.
Yeah.
Yeah.
There's
And the other thing I was like, just came to my mind. So if a single parent's earning less than $125,000,
Mm.
because that's the threshold,
Yeah,
how much of a loan can they get?
that's right.
You know,
What
Is it-
what would it be, Mr.
So that will come down to how many dependents you have,
Yeah.
your living expenses,
Yeah.
your other liabilities.
yeah.
So there's a number of factors how much you can borrow at the end
Yeah.
of the day.
The reason I said that was because I said, all right, maybe $500,000, $600,000,
Yeah.
but can you buy anything in a city such as Sydney for that much?
That's
Yeah.
right.
So then you
Where
look
the
at
average.
Yeah. Then you look at it. Are they trying to push people out of the cities?
True.
Because someone that's going to get their first home through this scheme, a single parent, I don't think they'll be able to afford anything with $125,000 as far as serviceability is
Yeah,
concerned.
Mm.
correct. Yeah.
Because you still have to service the 18% that the government's guaranteeing.
Mm.
Yeah.
So you are the serviceability is on 98%.
Yeah,
Yeah.
the serviceability is on 98%.
Mm.
And
Okay.
you have to continue to live in that home for as long as you're using that scheme. So
Mhm.
Wow,
if you're
okay.
still accessing
So
that
for 4
scheme,
years.
No,
No,
that's
no,
not
no.
that's a lady waiting.
Yeah.
Yeah.
Mhm.
so if you're still accessing that scheme, you got to live in that house for that long. So or you can go like 2 years later. You
So
can
I'm
refinance.
assuming, yeah.
So it all comes down to how you refinance later. But if you don't refinance, you've got that initial loan where the 18% was guaranteed by the government. You still have to continue to live that home because the government has guaranteed.
Guaranteed. So you got to basically wait on capital appreciation before you can refinance to another lender.
To unlock the equity.
To unlock that 18% as
The
well.
18%,
Right. So that's one. 10,000 places to 2,500 every year.
Yep.
The second one is already in place. It was there the last time around, which is not just single parents, singles and couples will just have to come with up with a 5% deposit, and they can go out there and buy an existing home or a new home. So that was already there. So they were going to open those 10,000 applications from 1st of July. But what they've added is they've added another 10,000, so 10 plus 10 now 20,000. But the extra 10,000 that they've added is just for new homes.
Okay.
Right.
So they're trying to stimulate the purchase of newer properties as opposed to recirculating the older.
Absolutely. So you'll have 20,000 spots this year from the 1st of July, 10,000 for existing homes and 10,000 for new homes, where you just have to come up with 5% deposit and the 15% is guaranteed. And again, those same rules apply, that you have to be Australian citizen if you're a single, and if there's two of you, then you have both have to be Australian citizens.
So that's the first time. What's that scheme called? First.
So that was called the home loan deposit scheme. They're calling it the new home guarantee because it's just applicable for new homes. The extra 10,000. So you've got a family home guarantee and a new home guarantee. Family home guarantee, single parents, 2% deposit. New home guarantee, singles and couples, but 5% deposit, and only on new homes to access that extra 10,000.
Which is stimulating construction as well.
And you have to be a genuine first home buyer. So you can't have any title under your name or any interest in any property anywhere in Australia.
Previously.
So it has to be, you have to be genuine, it has to be a first home. Basically. So those are the two stimuli for first home buyers. There's another one, which is the first home superannuation scheme. It was already there, but again, they've added on to the thresholds and the caps. So the first home superannuation scheme was you can contribute $15,000 a year before tax or after tax, non-concessional or concessional, into your super fund, right? And you can tell your super fund that you're contributing this 15K just for home loan deposit saving purposes. So then you can access it or withdraw it when the time comes to pay your deposit for your first home. Again, it has to be a first home, but I think it's worth mentioning, like before tax or after tax, you can decide whether you want to claim the deduction and pay tax at 15%. Again, it's fascinating because you only pay tax on 15% the moment it goes into the super fund. Or you can do a non-concessional contribution, which is after tax, and there's no tax applicable on that. How much you can withdraw? In the past, you could withdraw $30,000 if you're a single, 60 if you're a couple, but they've just raised the caps there. You can now withdraw $50,000 from your super to put towards your deposit for your first home.
Yeah, because if we have looked at some of the stats of how long it's actually taking someone to save a deposit with the level of growth that we've had, the first time buyers feel that it's just going to take them a lifetime to be able to save, because they've just about got that 10% or 20%, and now the prices have gone up and that percentage changes.
So what I see is a sub 1 million mark, the market will only
will be stimulated even more.
I think the main point they're trying to address is the prices which you've just mentioned. They're off the roofs, and I don't think
this will stimulate it more. I think in the sub.
I don't think, especially in cities like Sydney, in the urban areas, I don't think people are able to afford with the current prices. And you guys will have more on that. But they're trying to encourage people to step into the market so they can leverage off their houses and boost the economy somehow.
That's right. So obviously the construction side of it, that's why they're stimulating the new purchases, because the building of it is going to be generating more jobs, which is definitely critical. So now then the other part of it, which is increasing supply, because right now what we're seeing is there's increased demand. all of this will stimulate demand naturally because there's more interest in the market, but at the same time, some of the ways that they're trying to increase supply is the downsizers. So let's talk about that.
Yep, absolutely. So I'll come to that in a second because I forgot to mention an interesting point is people don't know, most people don't know that when they pull out their savings, their deposit savings from their super, they get taxed. Right?
Okay, yeah.
So the withdrawals do get taxed, you
Yeah.
know. As an example, if your marginal rate's 32.5%, right, and you know, you've got 2% Medicare levy, let's say, so you're paying 34.5% tax, you'll get a 30% offset for the withdrawal. So if you're withdrawing in that sort of an income tax bracket, you're up for 4.5% tax.
Okay, so it's not the full amount that
Yeah.
you're actually accessing. We've got a question here from Rajiv. What about self-managed super?
Yeah,
Are there any?
I mean, you can contribute towards your self-managed super.
And you can extract the same way, so you can.
Yeah, self-managed super and industry super funds, they haven't really put a rule around, because self-managed super fund, they'll behave the same way as an industry super fund, but yes, you get to have your own investment strategies in place. What do you want to do with that money, right? But you can't really do anything with the money that you've saved specifically for the home loan deposit or the home deposits. What you've put in has to be taken out only for home loan deposit purposes. Or you can even, I mean, leave it there. You're still subject to the normal non-concessional and concessional contribution caps. You can leave the money there if you decide, oh, I no longer want to withdraw it. And if you're a self-managed super fund, you can do something with that money and invest somewhere.
Oh, right. So you can purchase through super, which is always a possibility anyway.
Yeah.
So purchasing it through super, which remains through super, which is a great investment opportunity. Happy to discuss that. I think that requires a topic in itself, investing through super. So we'll definitely bring back that to you. So, Rajiv also has a few other questions. So are there any grants available for investment purchase?
Look, we're still going through the budget in detail. It's just been announced last week, but what I've read from a housing perspective or a property perspective, there isn't much there.
Okay.
Like I said, capital gains or negative gearing, they haven't really addressed that, and that's what investors would really like to hear. Yeah.
I've got another question from Kunal. What is the amount? So I think what he's trying to say is, what's the minimum amount that we can withdraw from super?
There is no minimum.
Okay.
The maximum you can withdraw is the 50,000.
Maximum is 50, no minimum.
Yeah.
Yeah.
It used to be 30, now it's 50.
Okay, so that's what's increased. And is there any benefits for people on PR? Look, I don't think so.
This one specifically that we've just been going through, yes.
Oh, okay.
The first home superannuation scheme.
Yep.
You don't have to be an Australian citizen.
First home superannuation scheme.
So where you're saving in your super for a home deposit or a home loan deposit, you can be a permanent resident and be able to access it.
There you go. Great question. Thank you.
And all right, your point, like the question you just asked, the supply
how do we
side.
increase the supply?
Yeah, look, yes, we've been focusing on demand. The government has tried to address supply, but I've read testimonials and opinions from economists, and they're all saying it really hasn't been addressed to the greatness it should have been.
Yeah.
So the downsizer is what we're talking about. So again, this has been available in the past as well, but they've just dropped the age threshold. So in the past, if you were above 65 years old, you could sell your family home and contribute up to $300,000 into your super.
Okay.
It was an opportunity for investors that are asset rich and cash poor. Because I say that because you already have an opportunity to contribute up to $100,000 anyway as a non-concessional contribution, and that's available to anyone. But you will only do that if you have the cash.
Yeah, where do you get the money from?
Where do you get the money from?
Yeah.
So this is providing those that were above 65, and that's been changed. It's now if you're 60 and over. So if you're, so in a way it's saying, all right, you can plan early for retirement. If you think by retirement you'll need extra funds available in your super fund and you haven't got any money now in your hands, you can sell your family home, maybe because it's a big house, you don't need it anymore.
Yep, empty nesters,
Right? And you can sell it, the cash that you get from it, 300,000 up to that amount, you can contribute it into your super. And what impact does that have on your super is another topic, because that'll get added to your balance in the super, then does it affect your pension? Yes, it does. To what extent?
Exactly. So there's
and in return, this could free up households.
Yeah, well, that's what it's all about. That's what they're trying to target, is to how do they incentivize those that have lived in their property for a long, or the age group, how can they get access to those larger homes for younger families to move in. So incentive is sell your property, contribute towards super, and then there's a whole heap of other things that come up with that.
Look, everything has its own implications and conditions, but again, it is worth mentioning that they're trying to increase supply by doing this, but how much supply is going to increase versus demand? There's a stat here saying, because this scheme's been there for a couple of years now, over 2 years, there's only been 9,000 people that have actually sold homes across Australia and contributed to the super.
Wow.
Right? There hasn't been much, but by dropping that age from 65 to 60, will that change things?
That's right.
It most likely will, but what sort of an impact is it really going to have? And I think there's a question.
Is it 50k per person if purchasing with partner?
No, then it's 100k.
There you go.
So
there you go, Kunal. So 100k.
So it is 50k per person.
Per person,
It was 30k per person.
Yeah.
Now it's 50k.
50k
so
per person.
you can unlock $100,000 of super savings.
To be able to purchase, which is
purchase.
has been one of the major concerns, I guess, to be able to buy a property, to get coming up with that deposit, trying to avoid the LMI as much as possible, where
using
possible.
the parent guarantee loans as well.
Yeah,
and it's worth mentioning if obviously if the downsizers are selling, they're selling, and that also provides an opportunity for investors to tap into those homes, maybe knock down and rebuild. They might rebuild townhouses, particularly particularly in urban areas. So the effect on supply could be twofold. So you could have double the effect on supply.
Exactly. So if they've got multiple, if they're building again and providing more supply, then definitely.
Provided you are able to demolish, rebuild.
There's the whole process for that. I was at a event yesterday where they were disclosing, the level of supply that's coming up in the Hills district, for example. There's it's 4 times more than what it was, the approvals of, especially for units and for commercial properties in the Hills district that have come into play, which means more supply. And obviously a more stabilization of the market. But in saying that, we will be bringing to you another infographic at another stage, which is the property clock, which shows how the property, from starting to rise to the actual peak and so on, so starting to decline and absolute bottom of the market and so on. It actually, from my experience, from what I've seen, it takes anywhere from sort of 2 to 5 years for that movement of the clock from one point to the other. So we've got good up to at least 5 years of growth still coming up in the market. Yes, it may not be at the crazy levels, of 15%, 10% and whatnot, but there is still time for the growth, which means anyone that's buying now is already ahead of the game in the next couple of years, because they've come up with that. Could someone... Okay, no problems, Rajiv. We will be in touch with you to discuss further offline to answer further questions. Not a problem.
I think we've covered everything that we needed to. We've gone into a bit of depth as well. But I personally believe, because house prices are going up, probably in a way where it shouldn't be that much. So they are trying to increase supply, but at the same time they're trying to push demand as well. Like economics, you'll only come to know when things actually happen.
And there's always a lag, even with monetary policy. When they change the interest rates, what actually happens is a matter. It takes a while for the effect to come into play into the actual economy. So all of these things are dependent on time, and the impact is seen only afterwards. But it's great to be able to discuss the what's happening, what the speculation is, and where it actually ends up. I think we're in a great market.
So I think to end things, all of us in Australia are lucky to be living here.
Absolutely.
Because with the rest of the world, especially I mean, we shouldn't be using that word, especially in countries that haven't got much GDP growth every year, but they're suffering at the moment, especially India and Brazil and everyone else. And whereas where Australia is about to go through a post-pandemic boom, it's coming, because they've got vaccination measures in place. They've got lockdown measures. They're behaving in a way that they're not going to let the virus come here.
True.
So
we're blessed. We're lucky.
We're blessed.
Just keep buying real estate.
That's it. Perfect. Well, thank you so much for your time, guys. Next week, we will be joined by Michael Bergier from Novak Properties to discuss all things commercial. Why buy commercial and who actually buys commercial? I did a poll yesterday with asking on our story. So do follow our stories because we do always have some interesting facts there. Asking the question whether people would be interested in knowing more about commercial or residential unit projects. I think commercial is something that people might think that it's only a certain type of group of people that buy and not everyone can buy. So we're going to be breaking that down next week. Michael Bergier from Novak Properties will be joining us to discuss that in more detail. Thank you, Manjot, for joining us once again and providing us with your sharing your words of wisdom. It was
great to be one of the first.
Exactly, that's it. And you're back here again. And if there's any suggestions for future topics that you'd like us to cover, please feel free to send us a message afterwards as well. We'll be more than happy to answer. And if you can recommend anyone that should be coming here as a guest speaker to discuss a specialist topic, we're happy to welcome them also. Thank you very much, guys, for watching. We'll see you guys next time.